on Fixed Income Market Insight, where we discuss what happened in the previous month and our outlook. The parliamentary elections concluded early this month, and polling results are out, with India having a coalition government this time. Also, this month's MPC meeting concluded on Friday, 7 June. The MPC kept the policy rate unchanged at 6.5% and retained its stance of withdrawal of accommodation. However, what was interesting to note was the diversion in views on the stance by the MPC members. Along with Professor Verma, Dr. Ashima Goel also voted to reduce the policy repo rate by 25 basis points and change the stance to neutral. To discuss more and to share his insight and perspective on the bond markets, updates, outlooks, we have with us our head of fixed income, Mr. Anurag Mittal. Post remarks from Anurag, we will take up the question and answers. Please note, you can post your queries anytime during this webinar. To make most of this opportunity, the link has been already provided to you. Without further ado, I will now hand over to Anurag. Thank you, and let's begin.
Good evening, everyone, and thanks a lot for joining in UTI Fixed Income webinar. The last 2 months have been quite eventful. There has been a lot of data. There has been a lot of political as well as key macro events, such as India also, India's rating outlook also being upgraded by S&P to positive. So we'll discuss the implications of these actions on Indian bond market and what it means for us as investors. So we'll start with the global trends and how what's really happening on from a fixed income point of view globally and what it really means for Indian policy making. So if we look at the global economy, it's a picture of resilience. So if you look at the left-hand side of the slide, which shows the manufacturing PMI and the services PMI, if you look at the blue line, which is the manufacturing PMI, it bottomed somewhere around the end of 2022 calendar year. The same time, we see the orange line, which is the services PMI, also kind of bottoming out. At that point, somewhere, it was expected by many market participants that the toll of the most aggressive rate hiking cycle in the last 30 years is slowly beginning to take on the global economy, and both manufacturing and services sector were being seen in a slowdown, and market participants were expecting rate cuts in 2023 itself. But if you look at these lines, they suddenly saw a strong rebound, both in the manufacturing and services. The services PMI, in fact, the rebound was quite strong. But even on the manufacturing side, it has been a picture of stability. And why it really happened? One reason was that the way fiscal spending happened in the US, it led to a lot of purchasing power with consumers. A lot of savings were left with consumers, which led to this sudden spike in services, as well as continued demand in PMI and manufacturing, as well as firms tried to rebuild their inventories. Secondly, as supply chains became normalized, corporate profits also improved. They remained strong, and hence it led to more resilient within the corporate sector in terms of employment outlook as well, which in turn further led to better consumption. So what's really happening today? So today, the US is still seeing quite strong growth. Eurozone, partially because of the energy price shock after the Russia-Ukraine war, saw technical recession, but now on a quarter-on-quarter basis, Eurozone economic activity is also improving. You look at China, and if we exclude real estate, even that is doing quite well. And post, the actions taken by the Chinese government as well as by the PBOC, even Chinese activity is expected to improve. So if you look at this consensus GDP diffusion index, which is which basically measures a degree that compared to the consensus forecast, how the next forecast are in the direction, whether they are in the upwards direction or in the downward direction. So if you look at the change in 2023-24, mostly the consensus forecast have been revised upwards for major global economies. So broadly, even the market commentators are slowly coming around to the fact that the economy is doing quite well. Coming to the next slide, as we can see, the pickup in economic activity globally is also reflecting in commodities. So on the left-hand side of the slide, we can see the Bloomberg Commodity Index, denoted in dollars. And as we can see, even post the 2024 early calendar year, now commodity prices seem to be going up. Again, it's a story of slight divergence. We can see especially precious metals like gold, silver doing quite well. We can see food prices doing well. We can see metals which are directly related to the new economy, which is the renewable sector or the EV sector, such as copper, aluminium, etc. They're also doing quite well, and that's what's really reflecting in higher commodity prices. Although they are going up, if we look at from a year-on-year perspective, they are still quite well behaved and not really inflationary in a meaningful way for now. We'll have to watch out future trends on how it impacts manufactured products inflation going forward. If we look at on the right hand side, which depicts the food price index, which is the FAO food percentage YOY, that's also started to go up, but again it's still in the slightly negative territory. So it's still because some of the food commodities are still doing quite well. And what really matters for food prices going ahead, and especially for India, is the trajectory of monsoon. If monsoon is healthy, it is well distributed, we should expect food prices to remain reasonably moderate. If you look at how inflation has been behaving, so if you look at, and this basically chart on the left-hand side denotes inflation trajectory across the major economies. As we can see, inflation has been coming down in most of the economies in the period of 2023-24. For example, in the UK, it's almost come to 2.3, which is close to the 2% target, while it still remains a bit elusive in the US. But we expect, from a forward-looking perspective, this inflation to further moderate because, one, your energy prices have been on the lower side. You're also benefiting from the base effects of slightly higher inflation last year. So even if prices don't go down materially, even if they are around similar levels from a base effect perspective, inflation should come down. And if we look at the momentum of inflation as well, as supply chains have been quite healthy, the momentum of inflation is also slowing down. But more importantly, while inflation can slow down, can it sustainably stay at these central banking targets? So for most of the central banks, we can see in the slide, the inflation target is 2%. Given that this disinflation is largely coming on the back of base effect and lower energy prices, which are volatile, we can't say with confidence right now whether this inflation will remain sustainable or not. And hence we expect modest rate cuts from most of these central banks, which will be largely maintenance, which will largely to bring the high nominal rates in line with lower inflation, rather than, one should not see these rate cuts as a sign of confidence in a lower structural inflation. As the next chart shows the 10-year sovereign yield movement in key economies. As we can see, the emerging markets were the strongest performers in May 2024. If you see Indonesia, yields fell down by 31 basis points. India and Mexico, yields fell down by 21 basis points, followed by the US, which fell down by about 18 basis points. Broadly, The focus of foreign investors in the month of May was carry. So wherever foreign investors saw decent carry, uh, within the global bond landscape, that's where we saw the flows. The reason why these foreign investors are looking at carry and not just mark to market gains is in a period where we are only seeing modest rate cuts, in a period where we are seeing that while there may be rate cuts, but we will be in a more higher for longer kind of theme. Probably focusing on accrual also makes sense as long as the underlying health of the economy is strong. And that's where we are seeing flows from a perspective of global investors. It's a quite an important theme, and it also has implications for our asset allocation as well, which we will discuss in greater detail when we come to to our view on Indian bond market. If we look at financial conditions, the left-hand side shows the US financial conditions index. As we can see, thanks to tight credit spreads, thanks to high banking liquidity, etc., the financial conditions index has been quite loose and quite easy for a long period of time. Although on the right-hand side, if you look at the market implied policy rate forecast, investors are broadly anticipating two rate cuts in the period of 2024 calendar year. So despite market participants, changing their forecast quite widely. So if you, for example, if you look at in January 2024, at same point of time, investors were expecting somewhere close to 7 rate cuts. In January 24, and from 7 rate cuts, we have come to only 2 rate cuts, as market participants now believe that probably growth will remain reasonably strong and inflation may not come down drastically. But despite that, your financial conditions index has been quite healthy, thanks to better equity markets, thanks to better banking system liquidity as well. So it makes the job for Federal Reserve slightly challenging, because on one hand, you're still fighting inflation, but on the other hand, your financial conditions are quite loose. And hence, probably we also agree, and that's why we are also been highlighting that probably Federal Reserve will not be able to cut rates very aggressively till they see a decisive fall in inflation around 2%. Coming to India trends. So the most important event which happened was the RBI policy, which concluded on 7th of June. So broadly, MPC voted 4:2 to keep the policy rate unchanged at 6.5%, and they retained the policy stance of withdrawal of accommodation. This was broadly expected within market participants, because RBI has been quite clear in the last 7 policies that they're focused on inflation until they see a sustainable fall in inflation, till they see inflation aligning towards their 4% target. They're unlikely to change their stance or change policy rates, given that we are still above the 4% inflation target, and we are expected to remain there for a while now. Market was not really anticipating any change in language, stance, or any policy rate. The most notable difference between the current policy and the previous ones was the external MPC member, Professor Ashima Goyal, also joined MPC member Mr. Jayant Verma to vote for a 25 basis rate cut along with a change in stance to neutral. While the deliberations of the MPC and the rationale behind these actions by the 2 external MPC members will be published in the minutes, which will be published somewhere around 3rd week of June, we still think of these developments as positive, because if you look at the overall RBI policy, RBI is quite confident on inflation. So as we can see, RBI raised the real GDP growth forecast for FY25 by 20 basis higher to 7.2%, as it expects better growth across all the quarters. So as we can see, it expects now 7.3% growth in Q1 of FY25, 7.2 compared to 6.9 in Q2 of FY25, 7.3 versus 7%, and 7.2 versus 7%. So broadly, it is expecting stronger and more durable growth across all quarters. But despite expecting higher growth in FY25, they are expecting inflation to remain unchanged. So this, we believe, the inflation growth dynamics is quite constructive. Even if you look at CPI inflation ex of vegetables, it's around 3.7%. So probably once there is greater clarity on progress of monsoon, probably RBI will be more open to at least change in stance, or modify the language to more on the more dovish side, and probably start to indicate towards policy easing. And the other notable thing which was there in the policy was that RBI indicated that they will bring out their discussion on neutral or real rates for India in the June bulletin, which should be released by end of June. What broadly they, central banks mean by real rates, they're nothing but the difference between the policy rate and the expected rate of inflation by the central bank. So, for example, if the RBI is expecting inflation to be around 4.5% in 4Q of FY25, and they're keeping their policy rate at 6.5, broadly it means that they're keeping a real rate of 200 basis points. If you look at historically, during the early 2010 to 2015 period, RBI was preferring to keep a real rate of 150 to 200 basis points, and post 2015-16, RBI brought it down to 80 to 100 basis points. So when we talk of real rates, what does it really mean, and why is it important, at least from a fixed income or central banking perspective? So real rate is broadly the rate at which economy is neither being too hot or being too cold. That is, it is not growing very fast or not growing very slow, and that is the rate at which inflation can sustain for a longer period of time. So broadly, what it really means for RBI's calculation is that if RBI deems that 150 is a reasonable real rate for India, at which inflation can align towards the 4% target, it still keeps space for some easing down the line, because even if you consider a 4.5% inflation and a 1.5% real rate, that still opens up some space for rate cuts going ahead. And 150 basis point will still be higher than the 80 to 100 basis points, which was the current real rate as deemed reasonable by RBI. So we'll have to wait and watch how RBI really views real rates for India going ahead. The third thing, which also may drive bond market going ahead, will be government's commitment to fiscal consolidation. So as I said in my opening remarks, that S&P had upgraded India's rating outlook to positive, and one of the preconditions that S&P had kept for rating upgrade in next 24 months was that the consolidated fiscal deficit for India, which is the center of the state fiscal deficit for India, should be close to around 7%. So assuming a 2.6% kind of fiscal deficit for a state, it broadly implies a 4.5% fiscal deficit for the center as well. So this year, the government had budgeted a 5.1% fiscal deficit. So market participants will be looking, when the government publishes their final budget in the month of July, how they plan to move on the fiscal consolidation roadmap, especially with higher RBI dividend. There is an expectation that government should be able to save some of it and show even a better fiscal consolidation than what they showed in the interim budget of for FY25. To recap, because of the elections, government had published only an interim budget in FY25 in the month of February. The final budget will be published by the new government in the month of July, as it happens in all the election years. So market participants as well as RBI will be keenly awaiting that. to see the trends on how the government is able to, balance between the capital and revenue expenditure without really, looking and or at inflationary impulses. Coming to domestic inflation rates, as we can see, inflation has been quite well behaved. It printed at 4.8%, which was broadly in line with consensus estimate. As we can see, one of the biggest drivers for inflation has been food inflation, which rose to 7.9% in April compared to 7.7% in March. Which was broadly due to double-digit inflation in vegetables and pulses. So on the right-hand side, if you can see, which is the CPI diffusion index, which broadly reflects the total weight of constituents which are reflecting or experiencing more than 5% inflation. As you can see, the share of constituents which are experiencing more than 5% inflation has been consistently falling. So it's a very polarized setup where largely the food inflation, and within food inflation, it's fruits, vegetables, pulses, etc., which are distorting overall headline inflation. And that's why RBI as well as market participants are looking at the progress of monsoon. And hence, if the monsoon is favorable, there is a widespread expectation that the future trajectory of inflation should also come down meaningfully, which bodes well for fixed income market. One point to note, as we can see, the Q2 FY25 inflation is projected at 3.8% by RBI. While it may look to be lower than 4, but we should keep in mind that it's largely a statistical base effect. As we would recall, last year, during the month of July and August, the inflation was around 7.44% and 6.87% because of 6.83%, because of high tomato prices. So as the base effects of that, inflation really take place, automatically the headline inflation for this July and August will go down. But that's again not sustainable. So RBI will be looking at future inflation and the future outlook of inflation to really take a rate stance. Coming to the monsoon update, we discussed how monsoon will be important for food prices globally as well as for our local inflation drivers. So as we can see, the IMD has forecasted a monsoon to be 106% plus minus 4% of long period average. And as we can see the previous track record of IMD, it has been largely, I would say, accurate. So if you can see, barring 2018, where inflation rainfall was 91% compared to 97% plus minus 4%, largely it has stayed on the conservative side. In fact, the actual rainfall typically has been higher than IMD's forecast. So hence, we do expect a normal monsoon this year. In fact, a normal monsoon should not only improve the prospects for Kharif, crop, which is the summer crop, it should also help the winter crops because it will help replenish the reservoir levels, which will overall improve soil moisture and give some resilience to Rabi crop in case there is some shortage in winter rainfall as well. Broadly, an update on the GDP. So the Q4 FY24 GDP surprised on the upside at 7.8% due to reduction in subsidies. If you look at because of that, your full year provisional estimate for GDP now gets revised to 8.2%. As we can see, the biggest delta, if you look at on the right hand side, which is largely coming from capex. So as we can see, the gross fixed capital formation is coming around 9% YOY, and that's really contributed to this high growth for the whole of fiscal year 2024. If you look at from the manufacturing side as well, if you look at the GVA, manufacturing has been a strong performer for FY24 full year. Manufacturing has grown by 9.9%, and even construction has done quite well at 9.9%. Services as well, especially real estate and finance, the financial sector continues to do well. So despite a very high base of 9.1%, it's grown at 8.4% for FY24. So broadly, the underlines of GDP as well as GVA look healthy. Uh, Probably GDP can even pick up higher in case the private final consumption, which was just 4%, probably picks up next year, and then probably we can expect a more sustainable growth going ahead as well. And it's because of this high capital led expenditure based GDP is why our inflation has been quite stable. We talked about fiscal consolidation and we talked about higher than expected RBI dividend. So this year in FY24, RBI declared a record dividend of rupees 2.1 billion, which has been high in recent years and compares to about 1 trillion, which was budgeted as dividend from RBI and other public sector institutions. So mind you, the dividend from other public sector institutions has still to be realized, and hence we do expect in fact further uptick compared to this dividend. The reason behind the high dividend this time was increased due to rise in foreign interest income for RBI holdings. So as we know, in the last 1.5 years, the global bond yields have gone up. Whether you look at Eurozone, you look at US, or you look at Japanese bonds, and of course, the largest portion that RBI has in its FX reserves is the US Treasury bonds. And that's where they saw a 71% YOY increase in income. And on the expenditure side, last year they made a significant provision due to the mark-to-market losses on their investment holdings. This year, as they've already done the mark-to-market, the requirement for provisioning came down. And hence, despite providing the full provision to, which is the so RBI has to provide a contingency reserve as a percentage of balance sheet. So the highest reserve that it has to maintain is around 6.5%. So despite maintaining the highest possible the contingency buffer, which is about 6.5% of the balance sheet, they still ended up declaring a higher dividend to the government. So the upside surprise is about 0.4% of GDP, which gives center room to either they can reduce the deficit or they can even increase expenditure without affecting borrowing, which is quite healthy for this year fiscal consolidation. On the credit deposit growth, broadly, what RBI has been trying to do, it has been trying to curtail the growth of unsecured personal loans, and as we can see, unsecured loan deaccelerated for the third consecutive month. So from 19.6% in March, it deaccelerated to 17.9% in April as the effect of higher risk weights on these activities took hold for banks. On the liquidity part, RBI has been intervening through fine-tuning operations through both VRRR, which is the variable rate reverse repo operations, in which it absorbs the excess liquidity, and variable rate repo operation, in which it provides liquidity in case of a interbank deficit. The last 2 months have been quite tight for interbank liquidity because the government spending was on the lower side due to the model code of conduct of elections. And that's why we saw this MIBOR rate, as we can see on the orange line, to be slightly higher than 6.5%. But now with government spending coming in, MIBOR has edged down. We do expect liquidity to get comfortable and in fact be quite surplus due to higher government spending as election period has ended, as well as on FPI flows due to the bond index inclusion. On the trade balance, nothing material. As we can see, April typically is a seasonal part. Trade deficits tend to widen at the beginning of the financial year, and that's largely what's played out. But overall, nothing concerning really on the trade front, which bodes quite well from a currency and FX reserve perspective as well. So if we look at the shape of the curve, the dark blue line is the yield curve as of 31st May 24, and as we can see, it's been largely flat. The reason of the flat curve has been a very favorable borrowing calendar, in which the demand supply has been quite favorable, as government bonds have been seeing very strong demand from long only investors such as provident fund, pension funds, and insurance companies, etc. And that's largely led to the longer end be quite anchored. If we look at at various points of yield curve more granularly, we saw that yields fell across the board on expectations of tighter fiscal. So when the RBI dividend was announced, there was expectation that government will be able to maintain a better fiscal deficit in which than even earlier projected. And as we can see, there was a fall in 10-year, 5-year, 3-year rates across the curve, across GSEC, AAA bonds, etc. So, for example, the 10-year bond yield came from 7.19 to 6.98. If we look at on the 5-year as well, it came from 720 to 705. So broadly, the declaration of higher dividend was taken quite positively by the bond market. On the outlook, largely, like we discussed, despite a higher GDP forecast, RBI has been expecting similar inflation. So broadly, one of the aspects which has changed for India, or at least has been prevalent for India for a while, and at least is expected to be there for a while now, that despite a higher growth rate, our inflation has been quite well behaved. So that's that bodes well, and that makes things easy for RBI because the typical or the textbook behavior of inflation growth dynamics is sometimes higher the growth, inflation can also be higher. But for India, because the focus has been more on capital expenditure than consumption, inflation has been quite well behaved. We already have two MPC members who are seeing space for rate cuts. Probably a favorable monsoon and outlook of lower food inflation can lead to earlier rate cuts from RBI as well. If we look at liquidity, like we discussed, it's expected to improve in the coming months on higher government spending on FPI flows. So broadly, it is quite favorable for the short to medium end of the yield curve. There is expectation of rate cuts. There is also expectation of improvement in liquidity, which should help the short to medium end of the yield curve. So broadly, the base case for 50 to 75 basis points rate cuts remains intact as inflation remains in a declining trajectory. We believe that typically moderate duration products can provide the better risk reward in a scenario of a shallow rate cut cycle. Typically, very high duration does well when we are expecting a deep rate cut cycle. In a period where we are expecting only a 50 to 75 basis rate cuts, and as yield curve is largely flat, so basically you're not really getting very high compensation for taking the duration risk, we believe that these bond yields provide a better opportunity. So broadly, if you look at the yield curve, like we discussed today, a 3-year AAA bonds are trading somewhere between 775 onwards. Even 5-year bonds are trading around 765, 770. So we believe that this is the part of the yield curve which provides good value. It is providing good carry as well. And if you remember, when we were discussing the foreign flows into various emerging markets, we were talking about carry. So that has been the theme globally. When we are not really expecting too many rate cuts, the focus is to build some duration, but also focus on the right accrual. And we believe that this part of the yield curve, these kind of products, which are typically like your short-term funds, your corporate bond funds, or the banking PSU funds, these kind of products make more sense for investors who have more than 12 months of investment horizon and some mark-to-market appetite. Investors who have a 6 to 12 months horizon can consider allocation to low duration or money market strategies, given the considerable gap between overnight and money market rate. As we can see, even AAA 1-year rates are right now around 770. Given that overnight rate is expected to be anchored around 6.5, and we are not expecting any rate hikes, this 120 basis kind of spread is also quite attractive for investors who have that kind of investment horizon. So that was broadly from our side. Thanks a lot for listening in, and now we can open up the floor to questions. Thank you.
Thank you, Anurag, for sharing your insights and presentation. The floor is now open for questions and answers. While I'll begin, for the questions to queue up, let me start with the questions we have already received. The first question goes like, uh, how might the RBI substantial increase in the dividend payout influence fixed income markets and investor sentiment?
Thanks, Sunil, for the question. So broadly, I think RBI's dividend cushions the fiscal in two ways. One, in case the government wants to provide more welfare or more, items for boosting consumption, that cushion provides, or that 1 lakh crores extra provides that cushion to the government to spend that money without really breaching any fiscal consolidation roadmap. Or in case they want to balance that out, they want to spend something on consumption and still maintain some fiscal consolidation, broadly they can use that. So bond market will be keenly awaiting the balance. So when if the government decides to fully use that 1 lakh crores extra to reduce the borrowing, the bond market may take it very, very positively. Uh, in case the government decides to fully use it, of course, there is a slight expectation that the government may save some of it. So the bond market may be disappointed in the near term, but the disappointment may not be very large because, anyways, the government has given out a gross borrowing number in the budget. If the government sticks to it, probably there should not be any meaningful disappointment on that front.
Sure. Thanks for that, Anurag. Uh, the next question goes like, while headline inflation seems moderate, food inflation outlook still remains a bit concerned. How do you evaluate inflation dynamics amid potential rate cuts and normal monsoon predictions?
Right. So, like RBI has mentioned the policy as well. The biggest concern right now is food inflation because it has been quite volatile, it has been quite unpredictable, and it has been repeated in the last 12 months in different aspects. Sometimes there has been serial inflation, sometimes there has been pulses inflation, so on and so forth. So, in case the outlook on monsoon is favorable and RBI has a reasonable confidence that inflation can move towards 4%, probably that will give greater confidence to RBI to go for policies.
Sure. The next question is, how effective do you think RBI's fine-tuning operations have been in stabilizing call rates amidst liquidity fluctuations?
So RBI has a certain framework that it is happy, to remain to let the weighted average call rate remain slightly higher or lower uh, than the policy rate. Since it's in a withdrawal of accommodation mode, it has been by its actions has let the sometimes the weighted average call rate remain on the higher side of the policy rate, where the bond market or the money market was also facing additional challenges was the lower government spending due to the code of conduct, and hence money market rates were tighter. And what's really happening now in the last 10 days is, as the code of conduct has ended, government spending has started to come back into the system, liquidity has improved. So I think more than the RBI's operations, it's about government spending. It's about the expected FPI flows on political stability. It's about the expected FPI flows on the index inclusion, which should drive the liquidity outlook going ahead as well.
Sure. The next question is, how do you interpret the implications of MPC's divergent voting on future monetary policies, especially regarding potential shifts in the stance and the interest rate?
Sorry?
How do you interpret implications of MPC's divergent voting on future monetary policies, especially regarding potential shifts in the stance and interest rate?
Uh, so we think that it is interesting that there are two members who are looking at rate cuts. It's a necessary but not a sufficient condition for future rate cuts. I think the future trajectory of RBI's rate action will really hinge upon how the monsoon progresses and their confidence on food inflation, as well as how they are seeing fiscal consolidation in the upcoming budget. Uh, Ultimately, it's the RBI members as well, that everyone has to be in the consensus uh, to really assess that inflation indeed is coming down. But we believe that we are in that direction. So two members have already said that they are foreseeing inflation to come down. Probably as other members also get that confidence, we should see more comfort to change this stance, and as well as to look at policy easing.
Sure. While you had covered a bit during your remarks, the question is, how does the RBI's revised GDP growth forecast versus unchanged inflation projections affect the balance between growth objectives and inflation targets?
So I think that's the great part about the forecast, that despite having a higher growth forecast, RBI is not really looking at higher inflation, and I think that explains the capital intensive led growth that India has been seeing for the last 2 years. So I think broadly, like RBI has been saying, the issue is not really core inflation, the issue is food inflation. So I think unless and until we see a sharp fall in food inflation or we see a sharp fall in growth, it doesn't really give a reason for RBI to cut rates. So probably one of them that has to happen, and we expect that food inflation will probably do the heavy lifting. And once the inflation starts to come down, probably that will give some space for RBI to cut interest rates.
The next question is, India manufacturing PMI fell to 3 months low of 57.5 in May versus 58.8 in April. What would have led to this slowdown, and what investors should interpret from this number and trend?
I think it's a noise. Investors don't need to interpret anything. I mean, PMIs or any number cannot be only one-sided up or one-sided down. There are seasonal variations. There are other factors, host of other factors which may or may not be a trend. So probably investors need to wait for at least 6 months to see whether it's a defining trend or whether it's just a one noise, which needs to be ignored.
Sure. In the interest of time, I'll take two more questions.
Sure.
What are the near-term and medium-term growth challenges for India's economic growth?
I think the near-term challenge for India's economic growth, one is to move from government capex-led spending to a private capex-led spending. So government has been showing a remarkable restraint in fiscal spending, and even within the mix of its spending, the focus has been on capital expenditure, on the assumption that government's capital expenditure will crowd in the private investment. So it is happening in some sectors, but it's not really widespread. And I think probably once we see more of private sector capex, that growth should become more sustainable. The secondly, even on the consumption side, it has been on the slower side for at least for last year, and probably at some point of time, once consumption also picks up, we should see a more sustainable growth both in the short to medium term.
My last question is, given the outlook for a shallow rate cut cycle and declining inflation, which fixed income products and strategies would you recommend for optimal risk reward?
Right. So like we said, we are not looking at a deep rate cut cycle. We are looking at a shallow rate cut cycle of 50 to 75 basis. If you look at the shape of the curve today and what we saw in the presentation as well, The 3 to 5 year, for example, AAA bonds are trading anywhere between 765 to 775. So even if the rate cut cycle gets delayed, the carry or the accrual on these bonds is quite attractive compared to other fixed income instruments. And hence, we believe that from a risk reward perspective, uh, the moderate duration products such as short-term fund, corporate bond fund, or banking PSU fund for investors who have more than 12 months investment horizon are appropriate. One, because they are providing you decent carry. Plus, they're also giving you opportunity to participate in capital gains in case the rate cycle commences as we envisage. The problem with very high duration is that one, it can be quite volatile compared to moderate duration in the near term. Secondly, it is dependent on a very deep rate cut cycle or a very sharp fiscal consolidation, both of them which we are not, at least we are not foreseeing in the near term. And hence we are, suggesting to investors to look at these kind of categories.
Sure. Thanks, Anurag. On behalf of UTI Mutual Fund, I convey our sincere thanks to the participants for joining in today. We hope you found today's session insightful and engaging. And we hope that we have been able to answer your queries to your satisfaction. In case we have not been able to take up some of your questions, please do write to us and we will try to respond to them. Please share your feedback on the link provided to you. Special thanks to Anurag for sharing valuable insights. We look forward to connecting with you in our next webinar next month. With this, we now conclude today's webinar. Thank you and have a very good day.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.